Good afternoon, ladies and gentlemen. Hope that everyone is keeping safe and well during these challenging times. We have come a long way since the onset of the pandemic and have been through many experiences in the market since then. Despite a challenging year in 2020, for financial markets, the year has been extraordinary to say the least. The global pandemic was a black swan event that caused the biggest quarterly drop in global GDP and increase in unemployment since the Great Depression. The drawdown in equity and credit markets was one of the fastest on record. There were many other firsts as well. Oil prices temporarily became negative. The volatility index surpassed levels observed during the depth of the global financial crisis. And already, robust central bank balance sheets ballooned an astonishing $7 trillion more. We as money managers have to constantly assess what this means for our clients' portfolios and how must we navigate such tumultuous markets. A simple philosophy that we hold dear is to protect and/or insulate our clients' portfolios from such pitfalls. By keeping a strong attention to the possible risks to any of the portfolios we manage in the global market. Managing a portfolio's downside is always paramount for us. Making sure that each portfolio encompasses the proper diversification necessary to survive such violent shifts in market trajectories ensures that we are able to generate positive value for our clients, always. The outcome of such measures and management techniques is generally continued outperformance over the long term. To achieve such objectives, we most definitely rely on our exposure to alternative asset classes, most notably hedge funds. Synonymous with their names, hedge funds offer us such defensive measures embedded within their strategies. They might not perform as well as their long-only counterparts during tremendous bull markets, such as the one we are experiencing now and have been experiencing over the last 5 or so years. But when it really matters, we expect them to outperform during these violent shifts and trajectories that the market has experienced during the same time frame. Over the long run, these risk mitigatory techniques give us the edge in delivering a constant set of positive returns for our clients, regardless of almost all market conditions over the long term. At Kamco Invest, being one of the largest independent asset managers in the region and managing roughly 13 billion in AUM, we aim not only to provide our clients with access to global opportunities, we also try to provide them with the right information that assists them in making informed decisions with regards to their portfolios. More importantly, we also provide them access to best-of-breed opportunities in the global markets, spanning 5 continents and across asset classes. As the Director of Third-Party Solutions Department at Kamco Invest, we do specifically that. We open up the horizon of investable opportunities on behalf of our clients. Through the various partnerships and interactions with best-of-breed managers globally, we can deliver a clear message to our clients on what the most important asset managers are doing to navigate the current and upcoming market challenges. More importantly, how they intend to approach various asset classes and how their investors are following suit. Through this webinar, we aim to give you insight on how such strategies are considered and managed through the eyes of specialists in the field. Downside mitigation with upside participation is the topic at hand today. Today, we are more than happy to introduce you to one of the relationships that the aforementioned subjects are a part of their DNA, and how they manage client capital with a track record in doing so that spans almost 30 years. Our guests today are Fundana. Fundana is a Geneva-based independent boutique which specializes in alternative investments, and in hedge funds in particular, for more than 27 years. Fundana is an authorized asset manager of collective investments regulated by the FINMA. Their objectives are to find managers early, to focus on the best managers, more importantly, to manage risks, not just returns. They strive to deliver solutions to their clients with a strong emphasis on simplicity, liquidity, and transparency. Their clients are family offices, pension funds, and banks. Fundana manages approximately $1.3 billion in assets under management firm-wide. Their fund, Prima Capital Fund, was incepted in 1993. Since inception in 93, the Prima Capital Fund's objective has been to provide equity returns over a cycle with half of the volatility of the respective indices. It aims to capture market rallies while limiting losses during market corrections. Thus, the strategy can be used as a defensive equity allocation for investors interested in such a profile for their portfolios. Their flagship strategy has a total AUM of approximately 950 million. Our guest speaker tonight from Fundana is Mr. Cedric Kohler. Mr. Kohler has joined Fundana in 2011 as head of advisory. Before this, he worked for Lombard Odier & as head of hedge fund advisory and head of funds of hedge funds. From 2004 to 2007, he was global head of firm-wide risk at Citadel Investments Group in Chicago. Prior to this, he was managing director at Merrill Lynch in New York as global head of margin and risk. He started his career with UBS in New York, London, and Zurich, and he holds a master's in economics and finance from Warwick University. But before we welcome Cedric, let me please assure you that we will be taking questions throughout the webinar. We'll be plugging in any of the questions received directly into our discussion as they are pertinent to what we are discussing. In the interest of time, and as the subject of the question is pertinent to our discussion. Should there be any residual questions that the webinar doesn't cover, then we will be happy to ask them at the end. Cedric, welcome to the webinar and thank you for making your time available. Would you be so kind as to take us through who you are, what you do, and a little bit of a flavor of your speciality and what makes your strategy so pertinent during these times?
Sure. Thank you very much, Faisal, for this very kind introduction and, of course, for this invitation. Greetings to everyone from snowy Switzerland. It is snowing here in Switzerland, as it should during the winter times. So this hasn't changed. A few other things have changed in the world, and I think, talking about what we do has become at the forefront of many investors' preoccupations. It's one thing to be investing into products that make a performance. It's another how you get to that performance. And having a defensive equity allocation has been something that most investors are looking for these days.
Sure.
So, you mentioned a lot about Fundana. Again, Fundana is a boutique. We're based in Geneva, Switzerland. We've been doing more or less the same thing for about 28 years now, almost 30 years, as you mentioned. And we are a boutique focusing on what we think is something that we understand relatively well versus trying to be an answer to everybody. And as you mentioned, our flagship fund, the Prima Capital Fund, which has about 1 billion AUM and a 27-year track record, is focusing on one specific strategy, which is equity long short, finding the best equity long short managers in the world. I'll come back to how we go about this. And really, first, I'd like to spend a little bit of time on giving you a few numbers so that you can understand what you can get out of these strategy. So last year we were up 20%, which is a very good result with respect not only to equity indices, but also with respect to hedge fund indices. We've annualized about 7% over the last 27 years with a volatility of about 7 to 8% and drawdowns, which are typically half of what you experience with equity markets. In terms of drawdown, at the worst of last year, during the worst of the crisis at the end of March, we were down 4% year to date with respect to either hedge fund indices that were down more than 10% or equity indices that were down more than 20%.
That's a good point. So when you experience a drawdown of 4% during this pandemic, that was the worst drawdown that you've experienced throughout the 30-year history of the strategy. Is that correct?
Yes, that was one of the worst, absolutely. And I think what people need to really understand is, the importance of, really mitigating those drawdowns. And in fact, I've prepared a slide. If Faisal, you would be kind enough to go to page 4. I think this will illustrate, how important this can be and how it's not necessarily that intuitive that low numbers can actually deliver very good returns. So this is a very simple analysis where you have two funds, Fund A, Fund B. Scenario 1, usually when I have people with me and we can interact, I would ask them, which fund, given the information I'm giving you on the scenario 1, which fund do you prefer? And obviously not too many people will select Fund A. People will select Fund B for its performance. Now, if we switch to scenario 2, you can see that for year 2, it's exactly the same numbers, except that the previous year you've had different drawdowns, right? The Fund A has had a drawdown of 5%, whereas Fund B has had a drawdown of about 30%. And now the answer is not that intuitive. And in fact, if I was to ask people attending today, we would get a lot of answers between both of them. And the reality is that with Fund A, at the end of those 2 years, you finish ahead of Fund B, right? So how you get through this volatile period is extremely important. Another way to think about it is, with the scenario 3. If I tell you, if Fund A on average will earn you 40%, and every time you lose 2%, do you prefer this, or do you prefer another fund, which on average, when you look at the gains, you would average 65% versus average losses of 15%. So now it's not that straightforward. And in fact, you should ask me, Cedric, it all depends on the probability of having an average gain or an average loss, which is what you've got in scenario 4. I show you the frequency with which you're getting those gains and those losses, right? And so when you look at this on scenario 4, it becomes more obvious that you would choose Fund A because you're much more likely to make money, even if when you make money, you make a bit less money than Fund B. And in fact,
how realistic is Fund A, or in scenario 4 of Fund A, having the frequency of 98% in terms of
So these would be, in fact, these are numbers taken from our fund, and the gains are over a 5-year rolling period over the history of the fund. And Fund B is more like an equity market index, like the MSCI World Index, right? So that gives you, because if I first tell you which one is which, people don't listen to the numbers, they don't look at the numbers. By doing it this way, it forces you to see that, yes, you earn a little bit less, right? But when you're losing a lot less. And that's really important because this will also give you the power of staying invested. So Faisal, if I can ask you to go to the next slide, please. The next slide is also relatively intuitive. If we look at the chart on the upper left, all of us know that when equity markets or markets are going through drawdowns, this is associated with emotions that we experience as investors. And these emotions can be tricky because, depending on the severity of the drawdown, they will force you to do something like sell at the worst time. And you will regret this, a few weeks, a few quarters later because of your inability to re-engage very quickly in the market. This is very contra how most of humans are working, right? So if you have the ability to stay invested and not being taken out by the market, this is really important. And in fact, just to show you how critical this could be, I've provided you with a chart on the bottom right-hand side. So what you see here is essentially 2 investments. The first one is a plain buy and hold over the last decade of an investment in the MSCI World Index, right? So you would start with 100, you would finish with 242 if all you did is buy and hold. Now, the second investment, all we did is we took out the top 10 best months over that decade. And by the way, 3 of them occurred in 2020. And you can see the impact is among us, right? Because you go from a result of 242 to 116, right? And so your investments goes down by half. So this shows that, being able to stay invested is really, really critical to compound returns over the long run. And that's exactly what we bring with this equity long short strategy is, reduce the volatility on the way down, give yourself the possibility to stay invested. Protecting the downside maximizes opportunities, really. And that's what we're trying to do here. So that when you're only down 4% and, equity markets are down 20 or 30, you don't need to worry about it. Now, of course, you need to have the proper benchmark in front of you, right? Equity long short is related to equity markets. It's not an absolute return strategy. This has been a little bit confusing, I think, pre-08, but things have evolved from there. So once you have that framework in mind, equity markets go up, will go up, equity markets will go down, but not in the same proportion. and that you understand that with lower volatility, you have the ability to stay invested, and that will compound over time. That makes a key difference for investors.
As a segue to how you do what you do, I think the obvious and the elephant in the room right now is equity valuations. Fixed income markets or bond markets have moved up significantly. Are we running out of options, or how do we tackle these mainstream ideas right now? So everybody believes it's a bubble that we're living through right now. We're just waiting for it to pop. As managers, we're getting paid to keep money in the market and manage it appropriately. How do you handle these concepts, and how do you apply that within the types of strategies that you select within your portfolio?
All right, so these are lots of different topics. So, you know, in terms of how our managers are positioned, I think I'll use one of the sentences that our manager has written in one of his letters, which is that, you know, trees grow to the skies, but, trees don't grow to the skies, but they can grow pretty darn high, right? And so, in other words, you know, managing capital in this environment is extremely frustrating because you have a desire to participate in the euphoria on the upside, and yet at the same time, you are scared by this irrationality, right? And so you're trying to, you know, figure out which one is going to prevail for how long.
And we're seeing these violent shifts even within a single quarter, as we experienced in March and the recovery following that in June.
That's right. That's right. So it can be very quick, and that's what our managers that we select need to appreciate and need to be able to physically be able to move the portfolio. So this has to do a lot with their AUM and the size of their balance sheet, as well as their mindset, right?
AUM, you say AUM, why is that important?
So, you know, we typically select managers that have AUM between $200 million and $2 billion. This is the sweet spot where we find that the manager is, you know, in a position to move around his portfolio as he sees fit, to change his ideas, or just simply be wrong. On top of it, the balance sheet that we like to have from our managers is typically, if you add the longs plus the shorts, about 150%, 100% long, 50% short. And that, you know, gives you a size which is roughly $1.5 billion of securities to move around. And that's very, you know, feasible to move this in the market without shooting yourself in the foot. So that, you know, for instance, in March, we had managers who were able to sell from their long positions without, you know, depreciating the price of that position even further. When you are $20, $30 billion fund with 8 times leverage, this is not something you can do. And so, you know, given what's happening in the marketplace, we really strongly believe that these managers with mid-sized fund AUM will do better over time. And in fact, if you look at some of these indices that are out there, you know, if you look at the HFRI Fund Weighted Composite Index last year, this was up 11.6%. So this is every single hedge fund with the same weight. Now, if you look at the HFRI Asset Weighted Composite Index, so meaning, you know, the bigger guys have the bigger weights, the fund was up 2.8%, right? So a very significant difference between those two. And that trend has been going on for 5 years. So we think this is really important to have mid-sized managers in your portfolio to be able to take advantage, well, first, not to get hurt on the drawdowns, and then take advantage of the extra volatility that the market is giving us these days.
Now, what about hedge funds in general? Will you look at long-only funds as a part of your strategy, or you're quite comfortable in being in hedge funds only? As you know, because of the rally that we had since the global financial crisis, long-only always outperformed hedge funds in general. Is it something that you are considering to add long-only, or you're comfortable with being in long-short equities or hedge funds specifically?
So I think it has a lot to do with our, you know, as an investor, your expectations in terms of returns, your ability to dig deep and understand where the returns are coming from, and then fine-tuning depending on what's going on in the marketplace. So as an investor, we're extremely comfortable with the return profile that equity long short give us. You know, this is, by the way, the oldest strategy deployed by hedge funds. It's the biggest strategy. And so, you know, it's not niche. And so it makes a lot of sense to focus on this. Unfortunately, 99% of managers are probably not worth looking into over a cycle, right? So you need to do a lot of work to find out who are the top 10 best guys that are out there that are adapted to the current market environment. And obviously, you know, the life cycle of managers has shortened over time. And so you need to adapt constantly your portfolio. We won't do longs because, again, we're trying to have this protection on the downside. Longs are not going to give you that. And in fact, for instance, typically Asian managers have a bigger net long exposure. And as a result, they will have a lot more volatility, right? And so it's not because you diversify from a country perspective or a region perspective that you are actually going to get some benefit of that, you know, having more managers. In fact, you could have what we often refer to as diversification. So, so we're very clear about what we're looking for, and maybe just to help people understand what we have in mind, if we could go to the next slide, please, Faisal. Okay, this is, you know, I mentioned a little bit earlier about the mid-sized funds. You know, when we talk about, we at Fundana, when we talk about long-short equity managers, we're talking about fundamental bottom-up stock pickers. These are managers that have a 12 to 18 months time horizon on stocks. These are managers that, you know, are looking for secular and cyclical drivers of stocks that are not well understood by the street, right? This is, you know, these books are relatively straightforward. It would be 20 to 30 stocks on the long side, 15 to 20 stocks on the short side. As I mentioned, 100 invested on the long side, 50 on the short side. Typically, we want these managers to have a focus, an area of expertise, which can be either a sector or a geography. These managers need to be good stock pickers, but also very good risk managers. Your ability to go through drawdowns in that strategy is not, you know, coming because you are buying puts, because you are buying factor hedges. A lot has to do with your ability to take the balance sheet, reduce it, and expand it as the time comes. So this is very important this is the first risk management tool, is to reduce risk across the board. This is extremely important, you know, when you have a lot of volatility, if you want to be able to manage the drawdowns correctly. So we're not talking about, you know, market neutral, short sellers, or all these sort of things, right? These are like plain vanilla type of managers where if something is going wrong with this manager, we can put our finger on it, whether it's a stock or an exposure or something like this. This is really something that we've been, you know, focusing on for many, many years now. And in fact, if we could go to the next slide, I can share with people, you know, one of the, the next slide then, one more. Perfect. You know, this is how we make sure we know what we have in the portfolio. There is nothing rocket science about what you're seeing here. The secret is in the discipline with which you're going to follow this and take action based upon the information you see here. So, you know, this is an example of one of our manager. You can see, you know, the longs on the left-hand side, the stock tickers, you can see the position sizes. You can see the market cap breakdown per position, and then the number of days to liquidate every single position, right? You can also see on the right-hand side, you know, a breakdown by market cap, by sectors. So, you know, again, nothing rocket science. Here, you're just checking that what the manager told you he would be doing is actually what he is doing, right? So making sure there is no style drift. There is another measure of liquidity this time at the portfolio level, which enables us to understand if the manager needs to liquidate the portfolio, can he do that? Does he have the option to change the portfolio? So that's why we have a 10 days first test. And you can see here after 10 days, this manager would have only 4.4% of the portfolio left. After 20 days, he would have about 0%, and 60 days, he would have nothing. So why 20 and 60? This is to see if investors are coming for redemptions, can he honor those terms? 60, whether or not he would have a side pocket. And then last but
yeah, please go ahead.
Yeah, just this one. Last but not least, on the upper right-hand side, where there is a box called performance and exposure, this is a model we use to essentially predict, forecast what we think, given a set of positions, given what the market did, what we think every manager should be up or down on a given day or on a given week or a given month. And every Friday, we'll take a snapshot for all of our managers across the board, and we will compare, what is their estimate with our estimate, right? So we compare their performance as they see it and the way we see it. And this is a phenomenal tool to force you as an investor to understand where the performance is coming from. And either you understand where it's coming from and you can decide whether you like it or not. And if you don't understand, then it triggers a call with the manager to try to understand where those differences are coming from. And so, this is how we avoid surprises. This is how we make sure that we don't have any style drift that could be coming from anything performance, or it could be coming from the AUM of the fund growing too big, which creates some liquidity issues at the stock level, right? So again, this is not rocket science, but having the ability to do this systematically ensures that you reduce quite a bit the surprises. It's not enough. You need to make sure that the manager has some alpha. We'll talk about this perhaps a bit later, but I wanted to share with the audience also first this concept.
A part of your philosophy, Cedric, I think we mentioned that in the introduction, is efficiency, transparency, and liquidity, as you discussed right now. Mm-hmm. How effective are such strategies that you seek out in emerging markets versus their developed markets focus? So are you be able to achieve it, or are the underlying managers able to achieve efficiency? Are you able to extract transparency? And are you able to deliver liquidity? Or are the underlying managers able to deliver liquidity as they so promised?
Okay, so the world of liquidity has evolved quite a bit, the liquidity risk has evolved quite a bit within the world of hedge funds post 2008. I think pre-2008, hedge funds had grown very significantly. And managers were looking for opportunities which put them at, looking for some illiquid positions, which paired with the monthly fund or quarterly fund was not appropriate. We went through 2008, there, what I think surprised the most investors was the inability for some managers not to be able to honor their redemption terms. On our side, in 2008, between September and December, we had about 40% redemption, so 40. And we managed to pay everybody on time with no gates, no side pocket, no suspension of redemption. And that's because, as I showed you on the template, we spent a great deal of time really figuring out, are these managers liquid? Will they be able to honor redemption terms? Now, many managers today are, providing different vehicles. So they give you the option to opt in for an illiquid investment. And if you don't want, you can opt out. But nevertheless, yes?
So you look at them as side pockets investments, right?
Yeah, so that could be in the form of side pocket to the extent that, if I'm talking about our flagship fund here, we are monthly liquidity, so we cannot allow these things to come in. But this is part of what we bring as well, and this is what I think investors need to do over and over again. It's one thing to do a due diligence at the onset. You need to constantly monitor to make sure that the manager is liquid enough to be able to move around the portfolio. This is really important, and especially after a bull market like we've had for this decade, people tend to forget, people tend to remain complacent, We've had very difficult conversations with, you know, a handful amount of managers that we exited after phenomenal performance, just because they got very good performance, they got a lot of inflows, and they didn't diversify. They reinvested into the same stocks, and, you know, whereas before they were one of the investor in a company, now they were becoming the investor in a company, which would, you know, lead to restrictions and things like this. So the point is that, you know, investors need to spend some, this is true for long only, this is true for hedge funds, this is true for, you know, a lot of things. You need to really make sure that the liquidity is appropriate with the fund terms. And that's really, you know, where you need to spend a lot of time deciding whether or not this makes sense. And if you are taking an additional, you know, liquidity risk, you need to get paid for it. That's obviously important.
Now, Cedric, what are some of the pitfalls that you see? What are some of the pitfalls or some of the things that you anticipate or keeps you up at night when managing this portfolio going into 2021, given the violent shifts that we saw over the last year, and obviously they have been dramatic? Are you positioned any differently from 2020 to 2021?
All right, so I'll talk about our manager selection, because we are not positioning ourselves from a top-down perspective, thinking, you know, markets are going to go up or markets are going to go down, or this sector is going to outperform this one. We had very low turnover in our manager roster last year, given the size of the drawdown in the marketplace, and feel extremely confident with our top 10 managers, which represents about 80% of our AUM. And I'll tell you why. There are a few things that we need to really make sure that these managers are well positioned for. Number one, we talked about the size of the AUM, the size of the balance sheet. Number two, you know, implicit with the size of the balance sheet is the size of the short book. Most managers, at least on the fundamental discretionary side, fail to be good short investors, either because the book is too large, or so, you know, like 80% and on the way up, on the rebound that you had last year, they got killed, or the positions are too large. You know, they put a 10% short position in a stock, and then, you know, suddenly something goes against him. And here it's a double whammy, right? As opposed to the longs, because if you're wrong on a short position, the position goes up, and the size goes up, the volatility goes up. So when you have a problem, your problem becomes bigger. As opposed to the long side, if you long something, let's say 10% of a position, the stock goes down by half, your problem got reduced by half, right? So this is, you know, critical for managers to understand. And then, you know, where they fail as well is to understand that the velocity of how they trade that book when the equity market is going up is not the same as when it's going down. So creating alpha systematically on the short side is extremely difficult. For us, we think of the short book mostly to help risk manage the long book, right? And this is what killed many managers last year on the market rebound, is to have too many shorts. You know, some managers, they see a stock being overvalued and they'll short it. But you may remember a good quote from Stanley Druckenmiller that says, you know, stock markets can remain irrational longer than you can remain solvent, right? And so, you know, you have to be patient as a shorter. You have to wait for the pivot in the market, and then, you know, find out when the time is right to press more. So that's on finding the structurally the type of managers we like. Now, you know, what is extremely, you know, important as well is to make sure that these managers have a clear framework of how to analyze the world out there. You know, so there's a few things here I can you know, highlight. Number one, when they look at a stock, they need to differentiate how fundamentals are affected and will evolve depending on COVID, depending on some secular trends, and depending on the cyclical situation, right? So COVID, for instance, you know, the big unknown out there these days are are we deploying fast enough? Are the vaccines working? We have new types of COVIDs out there. Will the vaccine work, right? All these things people need to be focusing on. In terms of secular trends, I think, again, one of our managers summarized it really nicely, which is access anytime, anywhere to all things. Tech is changing every single industry. Even 5G is going to change, legacy industries like the agriculture, for instance. But, automated cars, robots, you name it, right? There's a lot of things happening, and this is why tech has done so well, right? And COVID, has only accelerated this digitization trends across many industries, right? So that's one aspect. You have also trends in the semiconductor industry right now with a huge demand for chips. So you need to have people to be, aware of what's going on here and be positioned for it. Other sectors like consumer is likely to witness a lot of activity. When the economy reopens, this could lead to super cycle for profits for many companies and sectors levered to personal consumption, expenditure. Saving rates are really high. There's a huge fiscal stimulus coming up. And so people may suddenly, go out there, buy the things they always wanted to buy for the last 5 years, do that trip that they wanted to do for the last 10 years. Some other sectors which are more, interest rate sensitive, like consumer staples, could lag, given that they are, as I just mentioned, interest rate sensitive, because maybe there is a risk of overheating in the second half of next year. You also need to have managers who have been able to move from one style to the other. So, growth has outperformed value for quite some time now, right? And so, this was on the back of these secular trends, digitization, lower rates. This may change. And when this changes, you need to have managers that have shown their ability to refocus and to reposition the portfolio and manage these rotations and take advantage of these opportunities. So what we're looking for, Faisal, is, structurally, do they have AUM that's not too big, balance sheet that's not too big? And in their mind, do they have some, significant market awareness where, at times they will be, really focusing about fundamentals of these companies, which are misunderstood by the street. And at times they'll be thinking about the overall macro environment in which we're in to see if, one of these trends is being broken or something like this. And that's
yeah, please. Sorry.
No, and that's really what on the qualitative side, what we're looking for is having these managers to have the ability to have that framework in mind to be able to navigate. And the managers we had in the portfolio really understood this going into COVID, and so we think they'll do extremely well with this framework going out of COVID. If there is such a thing as fully going out of COVID, I don't think our life will be exactly the same, but something.
We're on the verge of it. We're certainly moving in that direction. And we're certainly moving in the direction where you said, people who haven't taken trips are going to be taking trips. So there's going to be a little bit of recovery and on a lot of the value names. But segueing into what you were talking about, you classify yourself as a bottom-up style manager on the overall fund of hedge funds process. But do you care how your managers look at the markets? Do you only look at bottom-up selectors, or do you look at top-down, bottom-up type of underlying managers within your portfolio, or it doesn't make a difference?
No, it's extremely important to look into this. First, we want to have managers who are good at picking stocks, making most of their money on alpha and not beta. That's a test we run regularly for them. They need to make alpha on the long side and a little bit of alpha on the short side. So that's critical. But, as important as well, when you go through periods like 2020, which is really macro driven, you need to have managers who are aware of some of these, what's going on in the market and how will this affect company going forward. Is this a cyclical problem, or is it structurally now a big problem for these companies, right? And so we need to have these managers first from a bottom up being good at what they do, but being able to manage the risk really, really well. And, so last year we've seen, because in the portfolio, we typically have 20 to 25 managers. The top 10 represents 80%, and then the bottom 10 represents about 10 to 15%. These are new managers we are testing in the portfolio. They're very small position. Usually they're less than 1% each, but we're testing them, right? And so, last year we entered into 9 new positions, and we exited 3 positions last year that we saw during the drawdown that they had the inability to protect on the downside. So we want to make sure this is what we're looking for. As a result, we have harder time finding the same quality of return to risk in Europe or Asia. Why? Because in Europe, first of all, markets are less homogeneous. You have a company in the UK and you're trying to short a company in Italy. So right off the bat, you've got, 2 different currencies. You've got different jurisdictions.
At the same time.
Right, and markets are smaller. And so at some point, managers start to do some market timing, and your, batting average or your hit rate ratio market timing is usually a lot lower than on stock picking, right? So again, you have to be very careful about between what the manager says and what he can do. We spend a huge, typically I like to say that 50% of the job is to know which manager to select. 50% of the job is to know when to exit one manager. And you need to spend a huge amount of time, monitoring what these managers are doing to make sure that, you're not waiting down 20% to exit. And that takes a huge amount of time for hedge fund manager, for us to monitor hedge fund managers. And perhaps if I can ask you to go to the last slide, Faisal, that might be a good way to talk about one important concept that people usually, underestimate when looking at hedge funds. So what you see on the slide here is essentially what makes the monitoring of a hedge fund so difficult. And this has to do with a relatively simple, intuitive concept, but that's yet not so well understood by many market participants. And that has to do with what we call the dispersion, meaning the difference in performance between the best managers and the worst managers. If you look at, let's take long-only funds. If you take, US long-only equity funds, if you take large cap, on a given year, the difference between, the top decile and the bottom decile between these guys will be 15%, 1-5. If you move to small cap, then it's 20%, that difference between the best and the worst guys. Now, if you move to hedge funds, that difference more than doubles, right? 47% on average. By the way, last year was the biggest dispersion in hedge fund returns that you had since 2009, right? So what this means is that even though you could have 2 managers called equity long short, their difference could be extremely different in terms of performance. One of them could be up 30%, the other one could be down 10%, right? Very big difference. Why is that? It has to do with the degrees of freedom that hedge funds have versus their long-only counterpart. You see, a long-only manager can overweight a stock, underweight a stock, and maybe have a little bit more cash than usual. But that's it. It's not so many, there's not so many degrees of freedom. A hedge fund manager can go long, can go short, can put some leverage, can go into any instruments, any regions, any strategy. And so, it's not because it's called equity long short that they have to do something very similar, right? And so if you look at the style of Lee Ainsley from Maverick, it's going to be extremely different from Deepak Patel from Allied, for instance, right? Very different type of approaches. So that's why you need to have somebody who's going to look into the portfolio. Where are the returns coming from? Is it in line with what I'm looking for? To be able to decide whether or not this is the time to exit this manager or not. We can keep it.
Cedric, what are some of the themes that you are pursuing? And I completely understand that you're a bottom-up manager, but there has to be some themes that you might be pursuing, or you see your underlying managers pursuing. One of them is the growth and popularity of ESG style investments. Is this something that is a cornerstone to your investment philosophy, or is it something that you're slowly transitioning into?
Yeah, so ESG is a topic that is very important in Europe. The challenge with this is that there is no consensus as to what is an ESG fund. And number two, the hedge fund industry in general is lagging behind, although it is catching up significantly. So what we've elected to do for our investors who actually need this is to do a ESG diagnostic. Because we know what our managers have in the portfolio, we can use a provider like MSCI, Sustainalytics, Robeco, whichever the investor would like us to use, and essentially do a rating stock by stock, manager by manager, and at our level. And so then we can have a meaningful discussions on any of the pillar, the E, the S, or the G. I think the themes otherwise that we are extremely active on would be, about 60% of our portfolios are dominated by sector specialists. And that is not to say that we are bullish on these sectors, but that's because there are tremendous opportunities within the sectors to create opportunities on the long side and on the short side. And typically within the equity long short space, you've got, I would say, three sectors that dominate. It would be consumer, healthcare, and TMT. Again, each of these sectors.
What was the last again, please?
So consumer, healthcare, and TMT. Technology, media, right? Now, we avoid sectors like financials or energy just because usually they are driven really by one macro variable for the most part, and then you don't have enough dispersion within the sector to create opportunities on the long and the short side. And this is even more so this year, given what I alluded to before. The technology is impacting every single sector that's out there. The access to anything, anywhere, to all things is really changing the way we do things. Look at us today on Zoom.
So quickly, yeah, we've adopted it.
So really the way we're doing things is changing. The consumer area is also creating some very interesting opportunities. I think we're underestimating once the economy reopens between the saving rates that every consumer has been able to increase, plus the fiscal stimulus, this could create some hyperactivity. And so healthcare is a little bit, so there is a little bit of activity obviously with respect to the vaccine and the stuff, but I would say these three sectors are going to give us, you see, anytime you've got a secular change in a sector, this is good for managers, right? This is good for managers, discretionary managers. And by the way, I forgot to mention, but the best managers last year, the best hedge fund managers in general last year were humans, not machines. There's been a huge trend towards artificial intelligence and this and that. When you have big secular changes happening in an economy, humans are much better positioned to analyze, synthesize, and take decisions.
Absolutely. And maybe in the interest of time, and I have a question here from Mr. Moise. I believe you touched upon it, but it's very important to ask. It's quite an insightful question. Hedge funds are known not to give a lot of transparency of their holdings. How do you obtain information on, or how do you obtain transparency on their liquidity and underlying risk?
Okay, thank you. This is a great question. This is an important one. It's a choice. As a summary, as what you would like to do as an investor. These days, which is different than pre-08, these days you get a huge amount of transparency. When we start investing with a manager, we tell him what we want from him. We're not operating with managed accounts, but we tell him, we need to have full transparency at the portfolio level, and then we see what he's ready to give us. If he doesn't want to give us anything, we will simply not work with him. Now, you can do this with mid-sized funds. You can do this with strategies which are relatively straightforward. I used to work at Citadel Investment Group. The number of positions, the number it would take to run the risks, is fairly complicated. If you give this to investors, thousand and thousand and thousand of lines of positions, securities, OTCs, investors wouldn't be able to do anything with it. And so it's a trade-off. We as investors decided to go only with managers that will give us that transparency. It's extremely important for us, but again, transparency is not the end of the game. You need to do something with it. Last year there were fund managers that had managed accounts on their underlying managers. So they had full transparency. They saw what was happening in there, and yet two of these managers lost them about 80%, right? And that costed them, a big drawdown for the year. Transparency itself is not enough. You need to be able to transform this information into action, right? And so this is, as you recall, when I explained to you that we try to forecast the performance of our managers every week, and that's how we use the transparency, right? To make it a useful information. We also make it useful for our investors. So, of course, we give the names of the managers in which we are invested in. But usually because they're mid-sized managers, it doesn't tell them much. But we also give the list of stocks on aggregate that our managers are invested in. And now that can be a very meaningful discussion together, because it's a chart with tickers at the bottom, and we can see that the biggest position represents 3% of the portfolio. So we can have discussions about that. We can have discussions about sectors, about liquidity. So it is a choice as investors to tolerate how much these managers are going to give you or not. We only invest with managers who are going to give us this amount of transparency. Again, we miss some opportunities, but we sleep a lot better at night.
Now, Cedric, I know we're hitting on you with a lot of questions back and forth, but I think another question for one of our guests is quite important as well. Since the advent of the global financial crisis, we're seeing a lot more hedge funds being a lot more transparent, consequently a lot more liquid.
Mm-hmm.
Do you have any opinion on the new wave of having usage-based hedge funds? Is this something you prefer, or it doesn't make any difference?
All right. This is also an important question, which we thought about for a very long time, long and hard. And it's a choice as well from our side, that we have decided not to invest in UCITS product because we can. It's not everybody that can have this approach. So for instance, a bank here in Switzerland, for efficiency reason, will select UCITS product because from a tax perspective, it will not be prohibitive on a French client, on a German client, Italian, German, Spanish, etc. Right? It has to do a little bit with that. The reality is that from a performance perspective, because of the additional set of constraints on the liquidity, the 5-10-40 rule,
concentration,
exactly, you typically find a big gap between the performance of a offshore vehicle and the UCITS product. And so as a result, typically the UCITS products are behind and usually lagging the offshore vehicle. So this has some implications if you're trying to build a portfolio of hedge funds. If you're trying only with the UCITS product, that means to compensate for this performance you're losing, you need to change something about your portfolio construction. And so that's the sort of discussions we have with investors, trying to help them decide, how to navigate through this choice. So that's, some strategies, obviously, that gap is a lot narrower. If, we're talking about things that are extremely liquid, or, even some of the long short side, but even on the long short side, we have many big surprises. And of course, as you migrate towards more illiquid type of instruments, that differences goes up. So I think it's a question of what are your constraints as a investor, and if you can do away from them, then I think it's a good thing, because you'll get better performance. It's not because it's UCITS that it's safer and more liquid. There's been surprises on also within that format. It's not because it's like on the road, right? The UCITS is when you put more signs to tell you to stop, to tell you to go. Some people have done the experiment to do with no signs altogether, and the number of accidents goes down. Why? Because when there are no signs, you're forced to look what's happening on the road, right? So when you have less regulations than maybe with the UCITS, you have to look what's in there, right? And that forces you to again understand what's going on. By the way, I just want to make sure I don't paint the wrong picture, but 95% of hedge funds now are regulated, either by the SEC or something on equivalent, but not necessarily structured within a UCITS format, obviously.
I have a last question from one of our guests, Hassan. He asked, is Fundana's hedge fund more suitable for a taxable investor or for tax-exempt ones?
So I think it really depends, where you're based. Most of our investors, they pay taxes, but the one challenge we have, we cannot accept U.S. Taxable investors in our fund, because we invest in offshore vehicles, right? So that's the only difference. But as far as I know, most of our investors, when they're subject to taxes, they are paying taxes. So we have a few investors, like pension funds, for instance, are not subject to taxes, but they're not paying taxes.
Well, Cedric, I think we've eaten up most of our time right now, and we certainly appreciate your attendance and your insightfulness. Maybe I should give a little bit of a closing remarks, if I may, and if you allow me. In closing, I would like to thank all those who attended, and most of all our guest speakers, for giving us such an informative insight on how they manage capital for their clients successfully for so long. Please also be informed that our next webinar will be in February. It'll be titled, How Should Middle Eastern Investors Approach International Real Estate Investing in 2021 and Beyond? With a backdrop of an enduring pandemic, ultra-low interest rates, and a generational change in demand patterns, commercial real estate investing has never been more challenging and more attractive. Kamco Invest and M7 Group are hosting a webinar to provide Middle East investors with deep insight into the opportunities and risks facing investors this year and next. Participants will discuss the core themes, emerging opportunities, and potential pitfalls of investing in the UK and Europe. Furthermore, they will shed light on how to find value in offices, why retail isn't dead but is different, and what effect the pandemic, Brexit, and other macro factors will have on yields, volumes, and investor appetite. This is but one aspect of the value that Kamco Invest team delivers to its clients. As a part of a multifaceted organization in managing capital, we hope that you enjoyed the content and our guests' discussion, and would be happy to carry on the discussion on this and many other topics in due course. Cedric, thank you. Please thank the team at Fundana. It's always a pleasure working with you and talking to you, and we look forward to the next opportunity.
Faisal, thank you very much again, and Kamco as well, for the invitation. We truly enjoyed this relationship. We as well, we enjoy a lot the region. We've been coming to the region for quite some time now, and we look forward to be able to, meet in person again.
We're done with the conferencing. I think we want to see you face to face again.
Absolutely.
Definitely. Looking forward to it, my good man.
All right.
Thank
Take
you.
care, everyone. Bye-bye.
Cedric, thank you.